I'm David Elijah, Director of Education and Training with TaxSlayer Pro, and in this session we're going to talk about the Tax Cuts and Jobs Act and what's changing on the 1040. A tax loophole is something that benefits the other guy. If it benefits you, then it's tax reform. This is a quote from Russell Long, who was a United States Senator from Louisiana. The year was 1986. The price of a gallon of gas was 89 cents. You could buy a Ford Mustang for a little over $7,000. Popular films were Top Gun and Crocodile Dundee. The number one song, Walk Like an Egyptian. There was no TaxSlayer in 1986. From the TaxSlayer website, the company's venture into software development began in 1989. A new tax software enabled Rhodes Murphy offices to complete tax returns on the computer instead of by hand, a revolutionary step that improved efficiency. The software increased the number of returns completed and raised the market price for services. When the software development was completed in 1991, it was named TaxSlayer Pro, after the original email address of Jimmy Rhodes, who's the company president. It was also the year of the Tax Reform Act of 1986, the most extensive review and overhaul of the Internal Revenue Code by Congress since the inception of the income tax in 1913, which resulted in the 16th Amendment. Its purpose was to simplify the tax code, broaden the tax base, and eliminate many tax shelters and tax preferences. The president at that time, the great communicator, Ronald Reagan. In December of 2017, with much fanfare, the Tax Cuts and Jobs Act was signed into law. It was called the most dramatic change to the tax code in more than 30 years. Republican congressional leaders claim that the act will spur economic growth and cut taxes for working families. So far, it seems to be working out. Under the Tax Cuts and Jobs Act, a typical family of four earning $73,000 a year could conceivably receive a tax reduction of as much as $2,000. Now, with that being said, let's look at a couple of scenarios and see how the Tax Cuts and Jobs Act might affect taxpayer situations. So first scenario, small business owners. Robert and Susan, both 41, own and run a small business and file jointly. The couple have net business income of $100,000 and they own a home that they're working to pay off. In 2017, they claimed $20,000 in itemized deductions, $7,000 of which personal property taxes, $8,000 in mortgage interest, $4,000 in state and local income taxes, and $1,000 in charitable donations. The 2018 result for their tax return, their federal taxes will go down $25.54. What changed? The standard deduction nearly doubles. The new tax bill boosts the couple's standard deduction to $24,000, which is up from $12,700. That exceeds the $20,000 in itemized deductions that they took for 2017. Their tax rate falls. The couple were in the 25% tax bracket in 2017. Under the new tax law, they're in the 22% tax bracket. They benefit from the new qualified business income deduction of 20%. Their qualified business income is $100,000, which is the net income from their shop, and their taxable income before accounting for this deduction is $68,935. This means they qualify for a deduction of $13,787, and this deduction does not lower their self-employment tax, though. Another scenario, family living in the suburbs. Julie and Nick are married and have 2 children, a son in college and a daughter in high school. They own a home, both still work. Their combined wages total $150,000. In 2017, they claimed $22,000 in itemized deductions. $4,000 of which in property tax, $8,000 in mortgage interest, $7,000 in state and local income taxes, $2,000 in charitable donations, and $1,000 in personal property tax, auto tags, things like that. 2018 result for them, federal taxes will go down by $2,577. What changed? Their standard deduction nearly doubles, but their exemptions will go away. The new tax bill increases Julie and Nick's standard deduction to $24,000, again up from $12,700. Nick, who's 66, also gets the extra $1,300 standard deduction available to filers who are 65 and older. However, the couple loses $16,200 in personal exemptions they took in 2017. The net effect, they pay their taxes on a larger amount, but their tax rate falls. The couple were in the 25% bracket in 2017. Under the new tax law, they're in the 22% tax bracket. They no longer need to itemize their deductions, since their standard deduction is higher than their itemized deductions of $22,000. They can take advantage of the child tax credit. The new tax law raised income limits on families claiming the child tax credit and raised the level of the credit from $1,000 to $2,000. They can also get a $500 non-child dependent credit for their son, claiming a total of $2,500 in credits. And finally, the scenario of the Atlanta exec. Raymond is a single man living in a condo he owns in downtown Atlanta. Last year he earned $500,000 as a senior vice president, and he claimed $135,000 in itemized deductions. $55,000 in mortgage interest, $46,000 state and local income tax, $24,000 real and personal property tax, $10,000 in charitable contributions. His 2018 change for him, his federal taxes, unfortunately, will go up by $6,396. Why? Well, his biggest tax deduction goes away. Under the new tax bill, the deduction for all state and local taxes, or SALT, is limited to $10,000. So his SALT total, which includes both income and property taxes, is $60,000 over the limit. So his overall itemized deductions drop by that amount to $75,000. His personal exemption also goes away. Under the new law, the personal exemption was eliminated. That increases his taxable income by $4,050 for 2018. His tax rate goes up. Tax rates were reduced under the new law, but in Raymond's case, the loss of that $60,000 in SALT deductions pushes him into a higher tax bracket. The top rate he'll pay on some of his income is 35% compared to the 28% that he paid in 2017. From the perspective of the 1040, according to Paul Ryan and the rest of Congress, we were to receive a tax return on a postcard. The Republicans promised that tax reform would give us a new postcard-size Form 1040, and Treasury Secretary Steven Mnuchin says they delivered. A new Form 1040 was released and posted on irs.gov this past summer. It'll be a postcard, as we promised, he said. Hardworking taxpayers won't have to spend nearly as much time filling out their taxes. What he didn't say, it depends on what sort of hardworking taxpayer you are. Did we get a 1040 like this? Not quite. If you wish to see the draft forms, go to irs.gov/draft forms to download and or print the available 2018 draft forms, instructions, and publications. Today's objectives for this session: we're going to go over the major tax law changes for 2018. We're going to compare the tax form changes from 2017 to 2018, and we're going to take a closer look at the new tax forms for 2018. First, Let's go over some of the major changes. You may have heard some of these before, but it never hurts to hear them again. Under prior law, taxable income was taxed at a graduated rate of 10, 15, 25, 28, 33, 35, and 39.6%. Under the Tax Cuts and Jobs Act, the rates are reduced. We still have the 10, 15 reduced to 12, 25 reduced to 22, 28 reduced to 24, 33 reduced to 32, we still have the 35, and the 39.6 was reduced to 37%. Today, about 70% of all taxpayers take the standard deduction, and about 30% itemize on their tax returns. The TCJA nearly doubles the standard deductions for every filing status in order to help more taxpayers bypass itemizing. The new standard deduction amounts are $24,000 for married filing joint and surviving spouse, up from $12,700, $18,000 for head of household, up from $9,350, $12,000 for single and married filing separate, up from $6,350. The deduction for personal exemptions has been suspended. Before the TCJA, the exemption amount was scheduled to be $4,150. For a family of 4, the elimination of the personal exemptions exposes $16,600 of income to tax in 2018. The child tax credit. The TCJA greatly expands the credit for millions of families. The child tax credit is available to be claimed for qualified children under age 17. The child has to be under 17 at the end of the year to claim the credit, as it has been in the past. And for 2018, the tax reform bill doubles the amount of the child tax credit from $1,000 to $2,000 per qualifying child. In other words, if you have one child, you'll be able to claim a $2,000 credit. For 2 children, your credit is $4,000, and so on. The tax reform bill also makes up to $1,400 of the credit amount refundable. In previous years, the child tax credit was a non-refundable credit. And remember, the additional child tax credit made the old child tax credit refundable. Even if a taxpayer has no tax liability whatsoever, he or she can get back $1,400 for each qualifying child starting with the 2018 tax year. The third big change to the child tax credit for 2018 involves the income qualifications. In previous tax years, the credit has only been available for low to middle income households. For instance, the credit began to disappear in 2017 for married couples who earned more than $110,000 and for single filers whose AGI was above $75,000. In 2018, the credit is going to be available to more households thanks to a raise in the phase-out thresholds. Here's a quick guide to the child tax credit phase-out thresholds for 2018. For single person, maximum AGI for full credit, $200,000. Married filing joint, $400,000. Head of household, $200,000, and married filing separate, $200,000. There's a new credit for other dependents, a smaller dollar amount than the child tax credit. It's a credit for other dependents. The tax reform bill also includes a non-refundable $500 family credit for other dependents. For example, an aging parent who depends on you for care, or a child whose support you provide but is 17 years old or older. There's a qualified business income deduction, or QBID, for tax years beginning after December 31st, 2017 and before January the 1st, 2026. A taxpayer other than a corporation will be entitled to a deduction equal to 20% of the taxpayer's qualified business income which is earned in a qualified trade or business. And in one of your other sessions, these terms will be defined. This Section 199A deduction is available to any taxpayer other than a corporation, and this includes individual owners of sole proprietorships, rental properties, S-corps, or partnerships, and an S-corporation, partnership, or trust that owns an interest in a pass-through entity. Continuing on with our major changes, for 2018, if you receive an alimony payment from an ex-spouse, then you still have to include it in your taxable income. If you're the one paying the alimony, then you get a deduction for the amount that you paid, just as in the past. You don't even have to itemize your deductions in order to write off your alimony payments. Remember, these are above-the-line deductions. On the 2017 1040, remember line 11 on the income section is where you report the alimony received, and in the adjusted gross income section on line 31A, report the alimony paid. Well, beginning in 2019, if you get divorced, then it doesn't matter how the payments between ex-spouses are treated in a divorce decree. All payments, including alimony, are going to be tax neutral, with no income or deductions available for either ex-spouse. Regarding the Affordable Care Act, taxpayers are still required to have health insurance for 2018. This caused a bit of confusion when the TCJA was first passed. Everyone thought that that was going to be the end of the Affordable Care Act. Well, not so for 2018. Beginning in 2019, the ACA shared responsibility payment, or the penalty, will be eliminated. Now let's take a glance at the new forms. The Form 1040, as you can see, has been considerably shortened. The new 1040 is a postcard-sized document, just as we were promised, with just 23 lines, down from the 79 lines that are on the 2017 1040. In a nutshell, the front contains all the taxpayer's identifying information, while the back contains the actual tax calculation. Some lines are new, like line 9 is where we report the qualified business income deduction. Some lines have changed, like line 17 is where we report the refundable credits. So where's the rest of the stuff that used to be on the 1040? Well, we have 6 new schedules. For many folks, the new 1040 will indeed make filing taxes simpler. For taxpayers who have complicated tax situations or tax returns, this may not be the case. In addition to the familiar schedules that most taxpayers have to use, or many taxpayers have to use, such as Schedule A for itemized deductions, Schedule C for self-employment income, there are at least 6 brand new schedules that taxpayers may need to use. The new schedules are designated by numbers now instead of letters, such as Schedule 1. Schedule 1 is for taxpayers with additional sources of income not from a W-2 or adjustments to income such as IRA contributions, student loan interest, and health savings account contributions. Schedule 2 is for taxpayers with some other forms of tax such as AMT, the alternative minimum tax. Schedule 3 for non-refundable credits. Schedule 4 is where taxpayers will add up certain taxes such as self-employment tax, uncollected Social Security, Medicare taxes, and others. Schedule 5 is to add up tax payments such as estimated tax payments or amounts that are paid with an extension. Schedule 6, where the taxpayer can appoint a third-party designee to discuss his or her tax return with the IRS. So you basically get the idea. It appears what they did with the old 1040, the 2017 1040, was chop it up into smaller pieces or smaller schedules. Well, if you've been paying attention, you've noticed that I haven't even mentioned the 1040A or the 1040EZ. We've been talking about the 1040. Well, the IRS is not developing the Forms 1040A and the 1040EZ for the 2018 tax year. All filers will use this new Form 1040 for 2018. Now let's talk about some significant changes. We'll drill down into some of the forms and see what's happening. First, let's talk about some changes to the moving expense deductions, the Form 3903. Under the prior law, under the 2017 tax code, employment relocation moving expenses were deductible if the move was related to a new job, if the new job location was at least 50 miles farther than the distance between the former home and the former job, remember the distance test, and the taxpayer worked full-time for at least 39 weeks during the first 12 months of arriving at the new location. Any qualifying unreimbursed or employer-reimbursed moving expenses were fully deductible and excluded from income and therefore not taxable. Well, the Tax Cuts and Jobs Act suspends the deduction for moving expenses for tax years beginning after December 31st, 2017, and it continues through January the 1st, 2026. Beginning in 2018, the deduction for moving expenses is eliminated. Any unreimbursed moving expenses won't be deductible. Any employer-reimbursed moving expenses will be not deductible, will be included in income, and taxable to the taxpayer. During the suspension, no deduction is allowed for use of an automobile as part of a move. In short, as a result of the TCJA, job-related moving expenses will no longer be deductible on an individual's federal income tax return. There is an exception, however. Any active duty members of the military will be able to deduct required moving expenses under the 2018 tax codes. If you read the new instructions for the Form 3903 under the Purpose of Form paragraph, use Form 3903 to figure your moving expense deduction if you are a member of the Armed Forces on active duty and, due to a military order, you move because of a permanent change of station. Now let's talk about Schedule A, itemized deductions, and the changes to this form. The deduction of PMI, private mortgage insurance, has expired. There's been a limit placed on the deduction for state and local taxes. I'm sure you probably have heard a little bit about this. The overall limit on itemized deductions has been suspended. Home mortgage interest deduction has been modified. Under prior law, you were allowed a deduction for interest up to $1 million of acquisition indebtedness. A deduction was allowed for the interest on up to $100,000 of home equity debt. Under the TCJA, this limits mortgage interest or the mortgage interest deduction to the interest on $750,000 of acquisition debt. The deduction for interest paid on home equity loans has been eliminated unless used to buy, build, or improve the home. The Tax Cuts and Jobs Act of 2017, which was enacted December 22nd, suspends from 2018 until 2026 the deduction for interest paid on home equity loans and lines of credit, again, unless they're used to buy, build, or substantially improve the taxpayer's home that secures the loan. Beginning in 2018, taxpayers may only deduct interest on $750,000 of qualified residence loans. The limit is $375,000 or $375,000 for a married taxpayer filing a separate return. And again, these are down from the prior limits of $1 million or $500,000 for a married taxpayer filing a separate return. Continuing on with the Schedule A, the TCJA suspended miscellaneous itemized deductions. In other words, the Tax Cuts and Jobs Act suspends all miscellaneous itemized deductions that are subject to the 2% of adjusted gross income or AGI floor. And this change affects unreimbursed employee expenses such as uniforms, union dues, the deduction for business-related meals, entertainment, and travel. As far as entertainment expenses and the deduction for meals, the new law generally eliminated the deduction for any expenses related to activities considered entertainment, amusement, or recreation. However, under the new law, certain taxpayers can continue to deduct 50% of the cost of business meals if the taxpayer or an employee of the taxpayer is present and the food or beverages are not considered lavish or extravagant. The meals may be provided to a current or potential business client or business contact. Food and beverages purchased during these entertainment events will not be considered entertainment if either of the following apply. They're purchased separately from the entertainment or the cost is stated separately from the entertainment on one or more receipts. And if we compare the 2017 medical and dental expenses section of the 2017 Schedule A and the 2018 medical and dental expenses section of the Schedule A, there's a little bit of a line change here. Line 2, enter the amount from Form 1040, line 38. Well, remember the 1040's been shortened quite a bit. On the 2018 Schedule A, we're told to enter the amount from Form 1040, line 7. Now, in the Taxes You Paid section of the 2017 Schedule A, remember we mentioned there's a limitation on the 2018 Schedule A. Well, in 2017, of course, there was no limitation on the SALT taxes or the state and local income taxes that you pay. But the 2018 Schedule A, again, looking at that state and local income tax section, we're told that there's a limitation of $10,000. The original tax plan called for eliminating the deduction for state and local taxes altogether. But as lawmakers debated tax reform, they agreed to only reduce that SALT or state and local tax deduction. The final tax bill signed into law allows filers to deduct up to $10,000 in state and local property and income taxes. In fact, almost all itemized deductions were slated to disappear, and this would raise revenue to partially offset the revenue lost as the rates on personal and business taxes were slashed. You can still claim a deduction for state and local general sales taxes. Instead of deducting the state and local income taxes from the W-2, the limit still applies to these state and local general sales taxes. For taxpayers in high tax states like California, New York, New Jersey, the limited deduction may have an impact on the individual's tax return. Looking again at the 2017 Schedule A and the differences, line 13, the mortgage insurance premiums, been eliminated for 2018. And here's a look at the section, the interest you paid section of the 2018 Schedule A. Gifts to charity, casualty and theft losses for 2017. There's a bit of a difference here concerning the Form 4684, the casualty and theft losses. And remember we talked about that 2% miscellaneous deduction area is gone. And just to drive home the point, under that 2% miscellaneous deductions, this entire section of Schedule A was eliminated and will no longer be in the program. Looking at the 2018 Schedule A, those sections are considerably shorter now. But we want to concentrate for a moment on the casualty and theft loss area, the 4684. Casualty and theft losses from a federally declared disaster are the only casualty and theft losses that will be allowed for 2018. And the total itemized deductions for 2017, remember we said that there was the limitation had been suspended. And if you look on line 29 is Form 1040 line 38 over 156.9, then the deduction may be limited. Not true for 2018. Next, we'll look at Schedule 8812, the additional child tax credit. The child tax credit has been increased to $2,000 per eligible child, like we discussed before. The additional child tax credit has been limited to $1,400 per eligible child, and again we've touched on this. Children who have an ITIN or individual tax identification number no longer qualify for the child tax credit or the additional child tax credit. Has to be a Social Security number. Filers who have dependents who don't qualify for the child tax credit will be able to claim a $500 credit for each dependent. Under pre-Act law, you could also use an ITIN or individual taxpayer identification number or adoption taxpayer identification number, an ATIN. If a qualifying child doesn't have a Social Security number, you won't be able to claim the $2,000 credit, but you can claim the $500 credit for that child using an ITIN or an ATIN. The Social Security number requirement doesn't apply for non-qualifying child dependents, but you have to provide an ITIN or an ATIN for each dependent for whom you're claiming the $500 credit. And here's an example of the 2018 Schedule 8812 showing the line number 4, number of qualifying children under 17 with the required Social Security number. Next, let's look at Form 2106, Employee Business Expenses. Can only be filed by Armed Forces Reservists, employees who have impairment-related work expenses, employees who received employer reimbursements, and qualified performing artists. Fee-basis state or local government officials, and the Form 2106EZ has been retired. Here's an example of the 2018 2106. Still show you vehicle expenses on the front and figure expenses to deduct on the back. And comparing, a quick comparison, the 2106 for 2018 and 2017, Section B, we multiply line 13, which is the business miles, by 54.5 cents per mile on 2018. For 2017, it was 53.5 cents per mile, so they're giving us an extra penny on the 2018 form. Form 4684, Casualty and Theft Losses. We've touched on this briefly. Personal casualty or theft loss can be taken only to the extent of a loss from a federally declared disaster. The form is going to have a new field for the entry of a FEMA code. And no losses from employee property are allowed. There's been a bit of confusion over the way Form 4684 will handle the casualty and theft losses going forward. Previously, all personal casualty losses that were not subject to the special provisions enacted in 2017 for hurricane losses and other federal disaster designations were deductible subject to the following. They were $100 deductible and then had to be in excess of 10% of adjusted gross income. I think we're all pretty familiar with that if you've ever done a 4684. Starting in 2018, non-federally declared disasters that result in personal casualty losses are no longer deductible. Going forward, only personal casualty losses in what are designated federally declared disaster areas are allowed. Disaster-related personal casualty loss shall be subject to the following: a $500 deductible. There's no AGI limitation in this case, no 10% floor, and the net personal casualty loss can be included on Schedule A or added to the standard deduction if it's more favorable to the taxpayer. From the 2018 Schedule A instructions, we read that line 16, other itemized deductions, you can take the casualty or theft loss from a 4684 and increase the standard deduction. If you have a net qualified disaster loss on the 4684, line 15, and you're not itemizing your deductions, you can claim an increased standard deduction. To do this, you list the amount from the 4684 line 15 on the dotted line next to line 16 as net qualified disaster loss and attach this Form 4684 to the tax return. You list your standard deduction amount on the dotted line next to line 16 as standard deduction claimed with qualified disaster loss. Combine these two amounts on line 16, enter them on the 1040 line 8. And you don't enter an amount on any other line of the Schedule A. Here's a glance at the 4684 for 2018, and that section: if the casualty or theft loss is attributable to a federally declared disaster, check here and enter the FEMA disaster declaration number. 6251, the alternative minimum tax, has an increased exemption amount and phase-out threshold. No adjustment for medical expenses, no adjustment for mortgage interest, no adjustment for miscellaneous deductions, no adjustment for the overall limit on itemized deductions, and the line for electing large partnership adjustments has been removed. Here's an example of the 2018 6251. And again, Part 2 shows that increased exemption amount. Next, we'll take a peek at the Form 8829, the business use of home. There's a new line for excess real estate taxes on the form for 2018. There's that new line there, line 17 in Part 2. Next, the Form 8867, the Paid Preparer's Due Diligence Checklist. We've all become auditors for the IRS if you prepare tax returns. The 8867 due diligence, there's new due diligence requirement for preparing returns of the taxpayer who's filing as head of household. There's a due diligence requirement for the credit for other or non-child dependents. And the penalty amount for not doing your due diligence, now $520. Form 8903, the Domestic Production Activities Deduction. If we look at the Form 1040 for 2017, that was line 35. The Domestic Production Activities Deduction has been repealed for tax years beginning after 2017. Taxpayers may still have a Domestic Production Activities Deduction for 2018 from fiscal year flow-through entities, and the reporting may have been moved to a write-in or other deductions line instead of having its own line. We don't know yet. Moving down the list to Form 8949, Sales and Other Dispositions of Capital Assets, there's a new code, Z, that indicates a deferred gain invested in a qualified opportunity fund. And on the 8949 for 2018, here's the front side of it. This is where the code will be indicated on line 1, column F. And again, from the instructions For the 8949, these are the code indicators and what they mean. "2018 will bring us some new forms. The Form 461, Limitation on Business Losses, Form 965, Inclusion of Deferred Foreign Income, 8879, Partnership Representation Revocation, Form 8990, Limitation on Business Interest Expense. We've got some retired forms. The 1040A, we spoke about this earlier, the 1040EZ, Form 2106EZ, Unreimbursed Employee Business Expenses. The 1065B, U.S. Return of Income for Electing Large Partnerships and Related Forms and Schedules. And Form 4626, Alternative Minimum Tax for Corporations. Just a summary, just a quick review table here. The prior law, 2017 child tax credit was $1,000, refundable up to $1,000. For 2018, $2,000, refundable up to $1,400. Individual tax rates, we talked about those, the top rate going from 39.6 to 37%. The standard deduction has gone up. Married filing joint from $12,700 to $24,000, single $6,350 to $12,000, head of household $9,350 to $18,000. Corporate tax rate, 35% maximum rates, gone down to a 21% flat rate. Pass-through income for 2017 was the same as individual rates, but for 2018 we get a 20% deduction. The AMT, Alternative Minimum Tax, individuals 26-28%, corp 20%, has gone down, the exemptions increased, and the corp has been repealed. Personal exemptions for 2017, $4,050, repealed for 2018. State and local taxes were deductible, fully deductible in 2017. For 2018, they've gone down. We now have a maximum deduction of $10,000. Mortgage interest, prior law, 2017, had $1 million limit. For 2018, it's gone down, a $750,000 debt acquisition limit. Keep in mind, the 1040 that we're looking at is just a draft, and as a final point, again, we want to remember, this is not the finalized 1040 that will be used during the 2019 tax filing season. This is an early draft, which the IRS simply released for informational purposes. The actual form that taxpayers will use eventually to file their 2018 tax returns may look significantly different. The IRS has said, in this case, we anticipate it's likely that this draft will change at least slightly before being released as final. While the draft of the new 1040 and the schedules will give you a good idea of what the 2018 tax law changes will look like on paper, these are not necessarily the actual forms that we'll file. Resources for this presentation included irs.gov, forms, tax reform, form changes, forms update, form 1040, and so on, irs.gov/download forms, prior year forms, and draft forms. I want to thank you for your attention to this presentation. Have a great day.